what's going on, y'all? We are back with another video, and in this section I want to mainly focus and just reiterate about the logic behind the market and why it moves and how it moves, because I think me teaching all these concepts, some people that don't have enough screen time and market experience may not really understand the logical side of the market and how you should frame it when you're trading or inside of your head. So that is essentially what I'm going to be doing today. You can ignore the chart here on the very far left. Those are trades I took today and yesterday. But let's just start off with framing basically how the logic of the market moves. Number one, we know from my previous videos I taught you guys that their market moves solely based on liquidity. That's all the market is moving based on. We have internal liquidity and external. You guys know internal is our POIs, is our OBs, whether these are flips, origins. External would be our swing highs and lows that are prevalent, right? And this could also be inducement as well. Inducement can also be considered a swing high or low for external liquidity. Now the market is literally moving based on these liquidity patterns. And I know a lot of people online, they teach traders they basically say that traders are only reacting and not predicting. I understand why they say that, but it's not entirely true, because as traders, we have to learn how to react and also predict. You need both sides of the coin in order to really see major results in trading. Because, for example, let's say you get an entry confirmation, right? Let's say you get an entry here to go to the upside. Well, what is our entry? Our entry, majority of times I teach you guys, is using the entry model. So our entry is the entry model. Maybe we had an OB entry model here off a higher time frame POI here. Maybe this is like 30 minute, right? We created an OB, and then we got in on the second OB with a limit order. Now, this entry here is reacting based on the market, right? We're trading based on the reactions of the market because price has given us confirmation. But what do you call our TP? Like for me, I rarely ever move my TP. Once I enter a trade with my stop loss and entry in the right position size, my TP, I set it there and I don't touch it. I don't touch my TP at all. I just leave it there. So what is that TP really called? Well, that TP is literally called us predicting the market, because we are expecting or predicting the market with high accuracy that the market will most likely, after these confirmations, will most likely get to this point of interest or this area. And a lot of times my TPs hit very, very accurately, and I'm able to catch almost the entire move basically with my whole entire position still open, right? So not taking a partials here or here, I'm taking the whole entire 100% volume of my position at the most extreme TP set point I have, where my draw on liquidity is. So that TP is literally our draw on liquidity, and draw on liquidity, as you guys know, is basically predicting the market before anything occurs. So regardless really of how price delivers here, my TP stays here. So that is literally called predicting the market. Our TPs are predicting the market and our entries are reacting off the market. Now, also there are situations where I teach you guys about inducement, right? So some people will take a demand zone here, but we as traders that teach you guys based on liquidity concepts and inducement, this is clearly inducement here. And so all those traders that are taking reactions off this POI are getting stopped out early, because they don't understand how to predict the market. They don't understand that this inducement here 80% of times does not hold. And so the market will still give confirmations, right? So when the market pulls back, comes back here, and it could still give you a confirmation like here to enter off an OB or an inverse fair value gap, and you will still get stopped out 80% of the time taking this POI, because this is inducement. But those traders that trade off just pure reactions don't understand how to predict the market ahead of time. They can't predict that this 80% of times does not work, and that the market is very likely to come back to this extreme origin POI here creating the actual move than this fake out right here. So this is why it's extremely important to have market experience. And I wouldn't call this 100% intuition here for this inducement, because I teach you guys already how to mechanically define inducement here. So you guys know exactly how to pinpoint inducement. So this is literally called basically predicting the market, and then we react on this POI because we predict this POI will 99% times, 80% times just not hold at all, regardless of what type of confirmation you get here. Now it would be a different story if price swept this inducement here and then gave us confirmation, because I tell you guys, if price takes out the swing point of the inducement, then yes, we can look for an entry model. It's still lower probability than waiting for the origin or flip down here, but it's a lot more probable than waiting for just the POI of inducement to tap. We want to wait for inducement to at least get taken out before looking for entry models, really. So that is basically how we should be viewing trading. We should be viewing it as we predict and we react. And this is why indicators, you can find a lot of times, they don't work the best unless you have experience with using the indicators and data behind showing that the indicators work with how you trade. Because indicators are not predictive, okay? Indicators are purely reactive. So regardless of what type of indicator you see, majority like EMAs, VWAP, all these things, SMAs, all these are reactive indicators that give you a signal when price is creating a reaction, but they cannot predict the market, right? They cannot filter out bad zones and good zones. And that is why I have a filtering system basically for my POI indicator. This indicator here is not drawing these zones or POIs based on math. It's not drawing zones based on reactions of the market. It's predicting the market, right? So for example, I have a 50% calculation where this will algorithmically basically do its own calculation of premium and discount, and it will mainly focus on drawing the POIs that are in discount or premium only for supply and the demand in discount only. So that is why it is extremely important to make sure that you understand the difference between indicators and using human decision making, because with human decision making with our brain, we can predict the market instead of just reacting off the market. Indicators only react off the market, and in this case, depending on the indicator, majority indicators will react just off the market. This isn't an entry type of indicator. This is literally just an indicator to draw zones. So that is a different type of topic, a different thing. But you guys know what I'm talking about when I talk about indicators, right? I'm mostly talking about those indicators that give you signals or have crossovers, like EMA crossovers, hold and VWAP, for example. All these things are based on the reaction of the market and not predicting the market. So that is definitely another thing to take into consideration. Another thing, for example, is I tell you that, let's see if I can draw this correctly here. In one leg of price, origins have a higher win rate than the flips. So flips, you can even call these, decisional zones or indecisional zones. I think that's what people call them, but they're basically the zone before the origin. And then the origin is obviously also known as the extreme zone. So I teach you guys based on my data collection ahead of time. You guys can feel free to collect your own data on this. Flips are less likely to hold than origins. So if you're trading a system, maybe your trading plan or a system you create your own trading system video I made, you can maybe focus just on trading off the origins. If that's the case, you will have a higher win rate than someone that trades off both flips and origins, but you will miss some moves because not all moves go to the origin. That's why I collect my POI type in my journal that I show you guys, because it helps me understand, okay, what percent of trades that I take really are going to the origin versus going to flip, and what's my win rate difference between flip and origin. And clearly from my journal, the flip win rate is lower than just taking trades purely off the origin, which makes more sense, right? Everyone wants the best price. And if you think about it, if we had inducement here and everything runs on liquidity, if we have inducement here, which is typically around the 50% level, And let's say price takes out inducement, but that is not enough liquidity to fuel the market. Why? Because think about it, if the market wants to go up, it has to take out sellers. Because for every buyer, there must be a seller. So for there to be enough buying orders to push the market and create structural changes in the market, which is very major, you need a lot of sell stops. You need a lot of people to hit stop loss, and you need a lot of sellers. So when price takes out inducement, maybe it wasn't enough to take out this structural high. Maybe price has to come back to the flip and collect liquidity here, as internal liquidity. And let's say the internal liquidity gets wiped out as well, because the market doesn't have enough fuel at the time to create this structural shift. And then lastly, we hit the origin, and then it creates a real move. So the basis and premise of the logic behind why these POIs have different win rates, for example, taking inducement, flip, and origin have different win rates, is because of the buildup of liquidity. Because inducements create the first layer of liquidity, flips create the second layer, and origins are the last layer of liquidity before the external liquidity swing high or low. So that is why the win rates are different for these different POI types, which makes a lot of sense if you think about it. Because let's say there's 100 lots, or you could say 100 orders of liquidity here resting at this inducement, and then down here, let's say there was 300, and at the origin we have the most liquidity here, or not necessarily the most liquidity would literally be at the swing point, right? So this external liquidity here, swing point, would have the most liquidity here. So every time price takes out inducement, that creates reactions, for example. So for example, if you're trading just off an indicator with a reaction, you would take an L here at inducement. You also take an L at the flip if there's a reaction here. But if you're predicting a market, you can choose to just not take these reactions here and just to focus on the reaction at the origin, because you see this works out with a higher win rate. So then you, after collecting all these layers of liquidity, price has then enough fuel to move to the upside. So this happens the same way if we're going to the downside as well. This is the logic and premise of how the market moves. The market is moved off an algorithm that basically is the job of the algorithm is to deliver, manipulate, and fill in everyone's order. And there's going to be people with orders resting below swing points as well, or under inducement, for example. Like there's going to be people having orders. Let's say we draw an example here. There's going to be people having orders at the flips, origins, and inducement. So if I can draw this out here, we have inducement here. There's going to be people having orders at all of these levels. This is inducement, flip, and then the origin. And the market algorithm is literally basically trying to facilitate trade. So it's trying to seek liquidity. That's the main goal of the market algorithm. That's how the market moves and finds real value. That's why Tesla, for example, is worth $230. Because of the market algorithm, it is delivering based on what majority of investors feel like is the best price. And that is the pure goal of the market algorithm, and it has never changed since. The reason why is because if the market algorithm changes, just think about it from a logical standpoint, the market just would not function. It just would not work at all, right? Because how are people going to get their prices they want delivered if the market is just always going in a straight line? The market would literally be going in a straight line without an algorithm. It'll be either going straight down or straight up, no pullbacks or nothing. There's a reason why pullbacks occurs, because the market is looking for liquidity at each and every single fractal part of time and price. So there's people with orders at the flips. Let's say there was only 500 orders here. And I'm not talking about orders here necessarily. I'm talking about like the size of orders. So for example, let's say there's $1 million here of liquidity. This is very little, by the way. $1 million is nothing in the market. But let's say there's 100 million here. Let's say this inducement only has 500K. So here it is. The inducement only has 500K of liquidity. Flips have 101 million, and the origin has 100 million, for example. Of course, this varies all the time, but this is just a rough estimate for you guys to understand this concept. of liquidity. The market is seeking out liquidity, right? So let's say it finds out 500K of liquidity is not enough. Well, where is the market most likely attracted to? The market is most likely attracted to where there's the most liquidity. So at times, majority times, the origin will have the most liquidity, but there are times where the flips might have the more liquidity than the origin, because buyers believe that price is not going to make big pullbacks, or the big institutions and investors are not placing their orders at the origin. Instead, they're placing their orders at the flip. So then the flips becomes a point where there's the most liquidity. Maybe there's 1 billion orders of liquidity here at the flip compared to only 100 million at the origin. What happens at that point? Well, actually the algorithm will deliver just to the flip and then create a new structural swing point, right? In an uptrend. So that is why price sometimes only goes to the flip instead of the origin. It just means because the flip had the most amount of orders in terms of monetary value. So that's why price reacted off the flip instead of the origin. But more than often than not, the origin will have the most amount of liquidity, but not always. And the reason why would institutions have their orders at not the best price? The best cheapest price would be down here at the origin. Why would they have their orders at the flip? Well, because maybe they had already took out enough liquidity at the inducement, or they created enough structural flow here that was faking out buyers early on that took out enough liquidity for them to have their orders here. Another reason is because there will be a lot of retail traders having their limit orders, for example, at the origin, and they never get filled because institutions don't want retail traders. This is the truth, but institutions don't want retail traders to get in with them at the exact price they are looking at. So that's why if they place their orders at flips, retail traders that place their orders at the origin will just miss out on the entire big move, right? Giving institutions the big uphand in terms of delivering price the way they want it, because no one else is joining in, and it is them that bought at the best price possible, because at this point the flip was the best price possible after this reaction. If this is truly where the most orders are, this is the best price possible. If the most orders are in the origin, that is the best price possible. So it all depends on where value is in the market, and the market is seeking value in terms of liquidity. Now, after we're done talking about liquidity, you guys know there's strong highs, weak highs, right? This is a weak high, this is a weak high. Strong low, strong low. You guys should know this in an uptrend, and vice versa in a downtrend. We call these swing points as external liquidity. So this is our draw on liquidity every time in an uptrend. We are drawn to the weak highs in an uptrend. Downtrend, drawn to the weak lows. So when price is in an uptrend, price is never going to deliver this clear, by the way, in terms of structure, right? There's always going to be microstructure here that confuses traders out, creating inducement as well potentially, right? That fakes traders out. So market is never ever going to create this clean of a structure. It does sometimes when there's impulse. This is where we use our impulse or limit orders. Like I tell you guys, when price is creating clear impulses where the internal structure is aligned with the external, that's when we want to use limit orders and impulse model to enter on the candle break, because you will most likely miss the move if you're waiting for a retracement. In this case, in an uptrend or downtrend, we're going from internal liquidity to external. Internal, external, internal, external, internal, external. That's how price moves in an uptrend all the time. And then same for a downtrend. Now what makes it different, if I can delete this, is if we're in a range, that's when it differs. If we're in a range, remember, you guys should know that market conditions, we mainly have two market conditions. There's the market is either ranging, consolidating, or accumulating. These all mean the same thing, or it is trending. Those are the only two main overall market conditions that we will have, right? Two main market conditions, and trending obviously will give us the best win rate. You can get an 80% win rate with trending markets. Ranging, you could be around 50-60% depending on how you want to trade them. But in a ranging consolidating market, let's say over here on the left, we were actually very bullish, and then we started creating this trend, this range. You guys should know this already. We apply my range model here for structure. You can either wait for sweeps to occur, or you could just take the origins only. You trade from the edges when we have a range. So in a range, for example, we can sometimes go from internal to then internal. So we sometimes go from internal to just internal. Like this. And then sometimes we can also go from external to external. So took out this low, external, took out this high, external, right? These are just swing points, by the way. So you could have sweeps on both sides. So in a ranging market, we could have a combination of internal and external liquidity, meaning in a ranging market, we could go from internal to internal. You also go from external to external. You also go from external to internal, or internal to external. So it is not completely random, right? I tell you guys, if we were truly in the uptrend prior and we're not in major supply on the left side on a higher time frame, we are expecting these basically, like for example, you mark this as a change of character, right? For example, instead of a change of character in a ranging market condition, we will be marking all change of characters and breaks, change of characters basically as sweeps, because 99% of the times these are sweeps actually. Because when the market wants to go up, remember we always need some fuel of liquidity, right? So if the market is trying to go up, it needs sellers to be induced to go up. So what happens is in an uptrend, we will prefer to take out the lows to induce sellers, hit stop losses of buyers as well that were buying at the origin, to then push higher. So that is our fuel of the market. This right here, that would be our fuel of the market. And in a downtrend, we'd like to take out either inducement, for example, or we take out, of course, making a fake change of character here, right? Because this right here basically was a sweep. We like to take out early sellers that were selling at the origin with their stops right above the swing point. They get taken out. And this also induces buyers into the market because they mark this as a change of character, but in reality we know in a ranging market condition, after a trend on the high time frame, it is more likely to be a fake change of character than a real one. So we mark fake break structures or change of characters, you guys know, as sweeps. This is a sweep and we're expecting the low get taken out. So all sweeps are, liquidity sweeps is fuel to go in the other direction. That's all it is. Just remember that. So for example here, this was just manipulation. This was just liquidity sweep to fuel the market to go higher. And so here, you'll mark this as a break of structure. And then what happens after, we go back to maybe for example internal liquidity, and then we continue to uptrend because we already took out liquidity here. What does this mean if you take out liquidity here? It means this should now be a strong low because we took out liquidity prior and we made a new high, right? So those two major things make this a strong low. It's now a strong low. We are anticipating price to come back to internal. And if it wants to continue higher, we should create a new break of structure. This is how the market fakes out traders with these sweeps. So remember, in a ranging condition, this is typically what happens, okay? And also the market never goes from internal to internal to internal to internal to internal to internal to internal. Like it never does that forever. Why? Because if price was continuously creating internal to internal, right, we'd be creating some sort of wedge right here like this. This is like a retail pattern they teach you, but this is what happens, right? You continuously create a smaller and smaller trading range, and typically this does not occur. This might occur in crypto because of how crypto facilitates trade, because I've seen this occur in crypto, but we're not trading crypto, and markets that are very liquid like ES and stuff or gold, this won't occur really ever like this, because price is going from internal to internal, and it's just holding internal the whole entire time, whole entire way. And when it does this, what happens? Well, if the highs and lows are being respected each and every time, the range is getting smaller And that is what happens. We create this wedge here, which eventually causes price at some point to break out to the downside or upside, or it could do fake outs, which gets very confusing, but this rarely ever occurs. The market is typically going from internal to external. If in trend and in a range, and you go from external to external, or a combination of the two. And let's say typically what I also like to apply to ranges, knowing and understanding that we cannot continuously go from internal to internal forever. What I like to apply sometimes for prediction of price, this works pretty well, is if we are in a range, if you go from internal to internal, okay, I'm expecting if this holds here that we should go to external again. So go from, let's see if I'm drawing this right, internal to internal. So first internal move, second internal move. I'm expecting this next move to be an external move and not an internal move, because if this next move becomes an internal move, that would be 3 internal liquidity moves in a row, and that rarely occurs because at some point we have to take out liquidity to fuel the market. So if you see internal go from internal 2 times in a row, so internal and then internal again, you can expect the next move to be external. And then vice versa for a downtrend, right? Internal, internal, external. Or internal, internal, external. Like that. Okay, so now that we understand that, there's one more thing I want to talk about, which is ranges. So the market, if we're trending, we're creating a range, right? Here's our 50% tool, right? I don't draw this on my chart anymore, but feel free to help you understand. This is our discount on premium. The market, whenever we're trading, we're always trading the range of the market. The market is always making a range of some sort. So if we're trending to the upside, we're making ranges to the upside, right? If we're trending to the downside, we're also making ranges to the downside. And this is where we get our PUIs. So this is our swing points, swing structure. And what we do is, of course, we pick our OBs, PUIs based on the swing structure, in discount if we're bullish, and premium if we're bearish. That's literally all it is, right? And then if we're in a range, this is pretty common sense. We're just creating bigger ranges. That's all it is. These are ranges, right? We can get sweeps, like I said. External can go from external. We can also go to external again. And then we go from internal to external. And then these would be our ranges. So price is always creating some sort of range, and that is where we select our POIs. So some people just get confused maybe if they don't have enough market experience to understand where should I be drawing my 50% tool, discount and premium tool, and you just draw it based on the range that the market is delivering or showing you. So in a range, clearly we want to be looking for the origins. So that is our range for POIs to draw on in a ranging market, and then this is for a trending market. Again, it's not going to look all this clean because we also have internal structure on the 1 minute creating its own microstructure. So this may confuse some people, but focus on the swing structure and you'll be good. So that's basically it for swing structure. That's all you need to really know and understand here for swing structure, and understanding basically where to mark your discount and premium tool, and that's where you put your POIs. And like I said, put your system together. Once your POIs get tapped in, whether that's through an alert, you can feel free to do alert. You look for confirmation to enter a trade and target the weak highs, weak lows, or target flips or origins, depending on what the market is showing. So that's basically it for this video. I just wanted to go over the logic behind what causes the market to move, why the market moves. Now you guys should know it just moves based on liquidity, and this is also how you draw your ranges, so you can be drawing your POIs within discount and premium of these ranges, whether price is trending or consolidating. So that's it for this section for me, and I'll see y'all in the next one.